In this video, we're going to look at what are dividend stocks and how do we pick the right dividend stock. I understand that there are already many intermediate level videos and blogs out there that cover dividend investing. But for this video itself, I'm just going to assume that you are new to dividend investing or you simply want to know or do a quick refresher on how to pick the right dividend growth stock. So first of all, let's understand the basics of dividend investing. Okay, dividend stocks are stocks that pay a portion of their earnings to the shareholders in the form of dividends. And these dividends can be paid on a quarterly basis or a yearly basis. So in fact, right, stable dividend paying stocks are getting more popular these days due to the uncertain economic climate. Everyone is panicking over the job cuts, high inflation, and high interest rates. And more importantly, tech stocks are just not the darling they used to be anymore. So, speaking of which, let's walk through a very simple example here, which is the McDonald's stock. Okay, McDonald's latest quarterly dividend per share amounts to around $1.52, okay, US dollar. And if you were to multiply it by the 4 quarters, you analyze it, you're looking at an estimated full year dividend of around US dollars $6.08. Divide these, okay, dividends by the share price of $291, your dividend yield is around 2.1%, which can be found easily on any investing related website like Google Finance. Okay, let's talk about how to choose the right dividend growth stock using 4 simple ratios. But before that, do subscribe to our channel if you want me to do analysis on more dividend growth stocks. And also leave a comment down below saying dividend growth stocks, please. Alright? In return, I will share with you a financial meme. Okay, with that, let's dive into our first ratio, the net profit margin. Yes, the first ratio that you want to look at for dividend stocks is not the dividends. In fact, you want to see whether they are profitable in the first place. For example, if you buy an expensive value meal, right, for $10 at McDonald's, if I tell you that McDonald's is losing money because of all the high labor costs, rental costs, chicken McNugget costs, then it wouldn't make any sense for McDonald's to pay out dividends, right? But you don't have to worry on that front because McDonald's is earning a lot. Around $2.60 for every $10 you spend on their value meal. So yes, the net profit margin for McDonald's is 26%. Okay, and the second ratio that I want to cover is dividend payout ratio. So this is a ratio that is quite important and a ratio that most dividend investors do not pay attention to. So what is it about, right? So it is actually a measuring of how much the company's earnings are paid out as dividends. So the calculation is pretty simple. You take the dividends per share divided by the earnings per share. And going back to our previous example of McDonald's, you can see here that they are earning $8.46 and paying $6.08 as dividends. So the payout ratio is calculated as of 67%. I want to do just a quick shout out for Simply Wall Street for this easy dividends analysis. If you are interested, you can check out the platform yourself by signing up for a free trial using my affiliate link below. The dividend payout ratio is important because it can inform investors on how safe a company's dividend is and how much room it has for future growth. Typically, the dividend payout ratio below 70% is sustainable and you want to avoid anything above 100%. If it's 100% means you're already paying dividends from your own pocket, right? Because you are giving out more than what you are earning. And a classic example that I always talk about is Starhub. So in FY 2018, their dividend payout ratio is as high as 1.4 times. Okay, and true enough, the dividends per share started to crumble from 20 cents in financial year 2016 to only 5 cents in FY 2020, down 75% in just 4 short years. With that, okay, let us hop over to the third financial ratio, net debt to equity. So next, we want to observe the financial position of a particular company using this net debt to equity ratio. Well, it sounds complicated, right? But this ratio can be simply derived from the balance sheet with the formula total debt minus total cash divided by the total shareholders' equity. Financial leverage can often be a double-edged sword. So during good times, the usage of cheap debt is an excellent way to grow a business. However, when times are bad, like for example right now when there's high inflation and things like that, the banks will be the first one that comes knocking on your door. Hence, it is for the very reason we would like a company to demonstrate a low net debt to equity ratio, preferably less than 100%. So a company that has a high net debt to equity might find that they have to prioritize the interest payment and the repayment of debt versus making dividend payments to the shareholders when the going gets tough. Okay, then for our fourth financial ratio, we want to look at the compounded annual growth rate of DPU. So we typically want it to be at least 1 to 2% for the past 3 years. Okay, because uh, dividend growth stocks itself have historically outperformed the market with less volatility. So notice I didn't say high dividend use. Yes, because they can cut the dividends anytime and you will face the share price plunge. According to the study done between 1973 and 2021, stocks that constantly increase their dividends outperform the rest of the S&P 500 index for capital growth. For every $100 invested, dividend growers and initiator stocks gain 14,400, while non-dividend payers only gain $989. So not only that, these returns were achieved with a lower beta, means lower volatility, and standard deviation. And companies that constantly grow their dividends are proof that they have a very strong fundamentals and a commitment to the shareholders, because what they are doing is they are just continuing to pay you irregardless of how the environment is doing, right? And there are two very good examples in the local context, which is DBS and HRNet Group, the company, the recruiting company behind Recruit Express. All right. So excluding special dividends, DBS have already grown their dividends 250% from 60 cents in FY 2016 to FY 2022. Okay, for HRNet Group, they have increased their dividends from 2.3 cents upon IPO to 4 cents today. So an increase of around 70%. So to end off, dividend growth stocks are a great fit, for any portfolio because they can help you to build a diversified portfolio. On top of that, the kaching, okay, the income from the dividends provide you a safety net, all right, to stay invested in equities during rocky stock markets. And you don't even need to spend a lot of time and effort to monitor these dividend growth stocks. Anyway, I hope you find this video useful. If you want me to dive deeper into more dividend growth ideas, do subscribe to my YouTube channel and leave a comment down below saying dividend growth stocks, please. So I will see you next time. Thanks for watching and ciao.